Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings. This quarter, Atlassian might be telling us some interesting tales in their latest report, so buckle up. Alright, so Atlassian just dropped their financial report for the quarter ending the 31st of December, and we've got a lot to unpack. This company, known for its work collaboration tools like Jira and Confluence, is navigating a big shift to its cloud offerings and bringing some new AI capabilities to the table. Let's dive right into the numbers, starting with their balance sheet. As of the 31st of December 2025, their total assets stood at a hefty $6.16 billion. Now, this is up a bit from the 30th of June 2025, where it was around $6.04 billion. A key thing that jumped out is their goodwill, which is basically the premium they paid for companies they acquired. This number shot up from $1.3 billion in June to over $2.3 billion by the end of December. This tells us they've been busy buying other companies, a strategy that can be great for growth but also carries its own risks. And speaking of goodwill, this number jumping so much means they've made some significant acquisitions recently. Looking back at their report, we see they acquired the browser company of New York Incorporated for about $488 million and a software company for around $720 million. That is over $1 billion in just a couple of deals, and that is where a big chunk of that goodwill increase comes from. It is a bold move to expand their offerings, especially with AI becoming so central, but we'll be watching to see if these purchases truly add value. Now, let's talk about the money coming in. For the 3 months ending the 31st of December 2025, their total revenues hit $1.58 billion. That is a solid 23% increase compared to the same period last year. Their subscription revenue, which is the recurring money they get from customers using their cloud services, is the big driver here. It grew by 24% to $1.5 billion for the quarter. This highlights their successful push towards cloud offerings, which is what most tech companies are moving towards. And the numbers clearly show this shift. Cloud revenue alone jumped by 26% to over $1 billion for the quarter. Data center revenue, their older on-premises software, also grew by 20%, but the real star is the cloud. It's clear they are making this transition, and customer demand for cloud solutions remains strong. But with growth comes costs. Their cost of revenues, which are the direct costs of providing their services, went up by 7% to about $237 million. While revenue grew much faster, this increase in cost, particularly in hosting fees, is something to keep an eye on as they scale their cloud infrastructure. It means they are spending more to keep those cloud servers running smoothly for all their customers. Their spending on research and development, essential for staying competitive, also saw a significant jump. It increased by 22% to $826 million for the quarter. A big chunk of this increase, around $141 million, is in employee compensation, and a notable $64 million of that is for stock-based compensation. This shows they are investing heavily in talent, especially with AI becoming a major focus. Marketing and sales expenses also rose by a substantial 38% to $376 million. This increase is driven by more spending on compensation for their sales teams, plus a nearly $30 million boost in advertising and marketing programs. This is a clear sign they are pushing hard to acquire new customers and expand their reach, especially with new AI offerings. All this investment, while good for future growth, did impact their bottom line for the quarter. They reported an operating loss of $47.7 million, which is slightly better than the $57.5 million operating loss they saw last year. It's not ideal to see an operating loss, but given their heavy investments in R&D and sales, it's not entirely unexpected, especially as they transition and heavily invest in AI. This also translates to their net loss per S-Hair. For the 3 months ending the 31st of December 2025, their diluted net loss per S-Hair was 16 cents. This is a bit worse than the 15 cents loss per S-Hair they reported in the same period last year. It shows that while revenue is growing, the cost of that growth and the investments are currently outweighing the gains in terms of profitability per S-Hair. Looking at the 6-month period ending the 31st of December 2025, their total revenues grew by 22% to $3 billion. Again, subscription revenue is the primary driver, up 23% from $2.3 billion to $2.8 billion. Their cloud revenue continues to outpace growth in other areas. Cost of revenues increased by 12%, and operating expenses also saw significant jumps, particularly in R&D and marketing and sales, largely due to compensation and the integration of new acquisitions. This led to a net loss of $94.5 million for the 6 months, compared to a larger loss of $162 million in the prior year period, which is a positive trend towards reducing losses over time. Now, Warren Buffett always talks about cash flow king, and I get why. For the 3 months ending the 31st of December 2025, Their free cash flow, which is the cash they have left after paying for operational needs and capital investments, was about $168 million. This is down from $342 million in the same period last year. The decrease is mainly because their net cash from operations decreased as they paid out more for employees, vendors, and taxes. It is important to note that while free cash flow is lower, free cash flow is still positive, which is a good sign. The company continues its share repurchase program, buying back $200 million worth of Class A common stock in the final quarter of 2025. They've authorized another $2.5 billion for future buybacks. While buybacks can return value to shareholders, it also uses up cash that could be invested in growth or used for acquisitions. It's a balancing act. Beyond the numbers, the filing highlights many risks. They're deeply invested in AI and acknowledge that these initiatives might not be successful, which could hurt their business. They also talk about the intense competition in the software market, AI technologies being a big area of competition, and the challenges of transitioning to cloud offerings. This risk factor, our AI offerings and investments may not be successful, is a big one. They are pouring resources into AI like their Rovo platform, but there is no guarantee it will pay off as expected. Competitors are also aggressively pursuing AI, and if Atlassian doesn't innovate fast enough or monetize these new tools effectively, it could really impact their bottom line. And of course, data security is always a major concern in tech. They mention that if their security controls are breached, leading to unauthorized access to customer data, it could lead to lost customers, damage their reputation severely, and expose them to huge liabilities. With AI, these risks might even increase as new attack methods emerge. So, what is the story here? Atlassian is in a period of significant investment and transformation. Their push towards cloud and AI is strong, driving substantial revenue growth, especially from existing customers. However, this growth is coming at a cost reflected in increased operating expenses, a wider net loss per S-Hair, and a dip in free cash flow. The successful integration of recent acquisitions and the payoff from their AI bets are critical for their future. The company shows resilience with positive free cash flow and a clear strategy to move customers to the cloud. However, the high spending on R&D sales and the integration of new companies means profitability per S-Hair is still a challenge. Their ability to successfully navigate the competitive AI landscape and manage the risks associated with data security and evolving regulations will be key. Looking at the full picture, Atlassian is a company making bold moves to shape its future in the evolving tech landscape. They are investing heavily in growth, which is a good sign, but investors will be watching closely to see if these investments translate into sustainable profits and a strong return. The transition away from their data center products also needs to be managed carefully to avoid customer churn and revenue dips. It is a company with a strong product suite and a clear vision, but the path ahead is filled with both significant opportunities and notable risks. Now, what do you think about Atlassian's aggressive investment strategy and their focus on AI? I'd love to hear your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more in-depth corporate analysis. And don't forget to join our Discord community linked in the description for more exclusive content and discussions. Thanks for watching, and well, see you next time.